Get ready for massive updates. DLA Aviation is preparing for a truly contested logistics environment through a major transformation. We dive into how the Defense Logistics Agency Aviation is reshaping its operations to handle today's complex supply challenges and what this means for future defense readiness.
Tired of dropping your phone or struggling to hold it with one hand? The PopSocket's Pop Grip gives you a secure grip, works as a phone stand, and even lets you swap the top for a fresh new look. Simple, useful, and perfect for everyday phone use. Click the link in the comments to grab yours on Amazon.
Next up, Raytheon is making huge moves in the defense sector. Raytheon has secured a massive contract from the Defense Logistics Group, Blue Raven, to produce 120 of their cutting-edge SharpSight radar systems. This is described by Raytheon officials as the largest single order to date for this new system, signaling a major expansion of its global availability. Now we turn to the energy and logistics sector with a deep dive into AESI's Q1 performance. Atlas Energy Solutions reported revenue ahead of expectations, driven by a crucial logistics recovery, as CEO John Turner highlights how operational execution and shifting logistics margins are fueling their growth. Finally, we look at the industrial real estate market. JLL reports that U.S. industrial leasing surged in Q1 2026, with 145 million square feet leased, driven by supply chain diversification and the massive demand from data center development. Stay with us to see how these shifts are reshaping the landscape and what's next. The Defense Logistics Agency, DLA Aviation, is undertaking a significant transformation to prepare for a contested logistics environment. This strategic initiative aims to enhance the agency's capabilities in a challenging operational landscape. The transformation effort is a key focus as the DLA Aviation reviews its annual operating plan, which is scheduled for August 1. This review is taking place at the Defense Supply Center, Richmond, where senior leadership, including Brad Bunn, Vice Director of the Defense Logistics Agency, and Steve Kinski, Acting Commander of DLA Aviation, are participating in quarterly briefings. The focus of this work is on adapting logistics operations to meet the demands of a contested environment. Raytheon has secured a significant contract from the Defense Logistics Group, Blue Raven, to manufacture 120 units of its software-defined SharpSight radar systems. Raytheon officials have hailed this as the largest single order to date for the new system, and a crucial step in broadening its global customer availability. The SharpSight radar is positioned as a platform-agnostic, multi-domain surveillance system engineered for deployment on both crewed and autonomous platforms. Its intended applications span a wide range of critical missions, including anti-surface warfare, border protection, coastal monitoring, search and rescue operations, and long-range surveillance. Under the terms of the agreement, Raytheon will be responsible for both the production and sustainment of the radar hardware and software. Blue Raven, formerly known as Crestwood Technology Group, will concentrate on the global resale and distribution of the system. This partnership is designed to offer operators faster and more cost-effective access to advanced surveillance capabilities within the highly competitive international defense market. Proppant sand producer Atlas Energy Solutions, trading on the NYSE under the ticker AESI, has signaled a strategic shift following its first quarter 2026 results, highlighting strong performance in logistics recovery and the expansion of its power business. The company reported revenue of $265.6 million in Q1 CY 2026, surpassing Wall Street expectations, although year-on-year sales declined by 10.8%. The non-GAAP loss per share was significantly below analyst consensus estimates. Management attributed the positive performance to a recovering West Texas market, driven by rising trucking rates and expanding logistics margins, which shifted from low single-digit to mid-teen levels by March. While severe winter weather and maintenance costs at the Kermit facility temporarily impacted margins, these issues were resolved by the end of the quarter. CEO John Turner stated that mining operations are effectively sold out, indicating robust customer demand and increased completion activity. The favorable market reaction was bolstered by these signs of demand recovery. Looking ahead, Atlas Energy Solutions is focused on capitalizing on both its power expansion and the logistics recovery. The company anticipates a ramp in contracted sand volumes and potential pricing upside as existing contracts conclude and production increases. A key strategic move is the new global framework agreement with Caterpillar, which secures substantial power generation capacity, positioning Atlas to meet rising private grid demand, particularly from data centers. CFO Blake McCarthy cautioned that industry volatility, labor, and equipment constraints could pose headwinds, but management remains confident in leveraging its infrastructure and secured supply chain to fuel growth in both sectors. Atlas' outlook hinges on sustained strength in contracted sand and logistics, alongside the scaling of its power segment fueled by new partnerships and market demand. The company's forward strategy will be closely monitored by the channel YouTube team, who will track the pace of new power purchase agreements, the stability of logistics margins amid contract repricing, and operational efficiencies from new equipment. Execution on these milestones and the competitive response to its power expansion will be critical indicators of sustained growth. Atlas Energy Solutions is currently trading at $18.44, up from $17.75 just prior to the earnings release. The U.S. industrial leasing market experienced a robust start to 2026, with significant activity driven by evolving supply chain dynamics, according to the latest Q1 2026 U.S. Industrial Market Dynamics report issued by JLL. The report highlights a 17.8% year-over-year increase in industrial leasing activity, totaling 145 million square feet executed, with 71.6% of that volume representing new leases. Asking rental rates remained modestly positive, rising 0.8% annually to $10.34 per square foot, as landlords balanced competitive pressures against the superior specifications of newer inventory. Notably, average direct asking rates for megabox warehouses saw a substantial 14.5% annual increase, outpacing all other Class A size segments. JLL senior analyst Elizabeth Holder attributes the leasing strength to several key factors. First, supply chain diversification and nearshoring manufacturing are accelerating the need for tenants to establish redundant inventory networks across multiple geographies. This necessity is directly fueling the leasing surge. Second, a new wave of industrial tenants is entering the market, spurred by the extensive infrastructure requirements of burgeoning data center development, which necessitates warehouse space for staging critical components like servers and cooling systems. Despite the strong leasing growth, Holder noted that rental rate appreciation was tempered by a healthy supply and competitive pressure. She characterized the market as entering a period of stabilization, where new deliveries are gradually absorbing existing stock, leading to a gradual decline in the national vacancy rate, which currently sits at 7.5%. This normalization is viewed positively, signaling a healthier balance between supply and demand. Big box leasing, defined as spaces of at least 500,000 square feet, showed renewed confidence, with an 80.7% annual increase in the first quarter, reversing the cautious stance seen in 2025. This rebound is fueled by renewed demand for bulk warehouse space, driven by strategic consolidation, where tenants seek single-site operations to maximize economies of scale in automation and inventory control. Third-party logistics, 3PL, service providers emerged as the most notable trend, with their leasing activity surging 65.2% annually and leasing over 30 million square feet. This surge reflects companies' increasing reliance on 3PLs for navigating supply chain complexity and gaining network flexibility during periods of disruption. JLL anticipates this momentum will continue as proximity to consumers and supply chain resilience become core competitive advantages for the industrial sector.